Hello and welcome to Simplify Your Retirement podcast with Stephen Strickland from Wise Wealth. Good morning, Stephen.
Good morning, Paul.
Excited to be here today. We have another great episode lined up here. This season we have a lot of guests on, a lot of experts in different areas, and one of the things we want to do is be able to bring education, which is one of the foundations of Wise Wealth, education to our listening audience, so they can learn things.
Yeah.
So sometimes education comes in the form of helping people, again, understand what they have or why they own what they own. Sometimes it comes in the form of hearing something new.
Right.
We've had an episode on that, things like that this year. And also, sometimes, though, education comes in clearing up misunderstandings. So sometimes people hear about something and don't realize what it really is.
Absolutely.
And I don't know if you've ever come across anything where you hear it and don't know if it's true.
Right. Well, we spend a lot of time educating people on the planning process in our expertise. And so what we want to do is add value to people by bringing up topics that are out there. People are talking about it. It may not be our expertise here at Wise Wealth. And so we leverage the relationships that we have, the connections that we have in the industry, and we want to make sure people understand. My biggest approach to this is people are going to hear about, like our topic today, we're going to talk about reverse mortgages. My thought is this: if someone's going to learn about reverse mortgages, I'd rather have them learn it from us.
Yes.
And so we're going to have our philosophy here is always that we don't believe there is such a thing as a bad investment, only a bad fit.
Yes.
We don't think there's such a thing as a bad product, maybe a bad fit. So we're here to say, hey, we want everyone to understand there is a thing out there called reverse mortgages. They are not good or bad in and of themselves. Does everyone need a reverse mortgage? No. Do some people need a reverse mortgage? Yes.
Absolutely. And
so it's really just becoming educated on it. And we want all clients to never be closed-minded about anything. At least be curious, understand what it is before you make a decision. That's really what this episode is about today.
Yeah, that's for sure. And I know that you do a great job of finding experts that we trust, and since we vet and make sure so that when we're giving information, we know that it's the best possible information we can give. And so experience goes a long way.
Yes.
Right? I mean, I know with my lack of hair, you can't always see the gray in it.
Right.
And so you don't know that, hey, I've been doing this 20 years. But when someone says, I've been doing this for 20 years, you start to go, they have some experience.
Absolutely.
Right?
Well, the great thing about our guest today that we share in common is 20 plus years of experience and gray hair, Paul. So I don't know if that's what you're trying to say or what.
Finding out that he has 20 plus years of experience in the mortgage industry too. And many of those in dealing with reverse mortgages. It says, this guy probably knows a little bit more than me about this topic.
Absolutely. Well, Harlan Accola, great to have you here on our podcast today.
Awesome to be here. Thank you.
Harlan is with Movement Mortgage, the National Reverse Mortgage Director for Movement Mortgage. Harlan is also the author of a book called Home Equity and Reverse Mortgages. I have read that book, and certainly one thing that we have in common, Harlan, is the desire to educate people on what this is. And I know that's a passion of yours and something you've been doing for a long time. So tell us how you got into the reverse mortgage, industry first. If you want to tell us a little bit about you and the book, and then we'll just go from there.
Well, in the beginning, Steve, I hated reverse mortgages. I told people to stay away from them. They ripped off the old people and hurt their kids. And that was just my standard uninformed advice, which was not good. And then one day I lived in Wisconsin, and I was invited to a reverse mortgage seminar for training in Miami in January. If you live in Wisconsin, you go to all seminars in Miami in January. Right. You don't care what they're about. And I figured I'd just skip out and go on the beach. And after the first day, I realized, Harlan, you didn't know you were talking about, and that there was a very different situation. And so I sat there, really listened to things for 3 days, then came back to my financial advisor and said, hey, I want to run some numbers. I think this makes sense. I think I'm going to get a reverse mortgage when I turn 62. And he said, well, Harlan, you said those were awful. And we started running some numbers, and it turns out that the math proved out that, oh, this makes sense. And here, 20 years later, I'm 64. 2 years ago, I did my own reverse mortgage.
Amazing. Okay.
So it's, and my parents had one before they passed, and my wife's parents, and my uncle, and people in our church, and friends and relatives, and I've done over 1,000 of them now.
Well, it's interesting that you say that, because it's the same thing with me, Paul and Harlan. I think that's where you and I met. I think I've heard you speak at a conference, and same thing. I go to these financial planning conferences, sometimes to get continuing education credit, sometimes just to get away in the winter, sometimes just to broaden my horizons. And one time I was at an event, and same thing, pretty much closed-minded to reverse mortgages, but it was on the agenda. Someone spoke about it, and same thing, kind of light bulb goes off and says, well, wait a minute. There's a reason why these exist. And really, we talk about it a lot here. Obviously one of the largest financial assets that someone has is the equity in their home. And just over the years that we've worked with clients, we look at it and we say, we kind of just look at someone's home equity and just, it's kind of a dead asset. We don't really, no plan for that. Great. What is your equity in your home? Great. We'll write it down on the piece of paper. We'll add it to the net worth statement. Really nothing really we can do with that. And so we kind of just ignore it. But that it's a major, major part of someone's net worth.
Well, it's become the elephant in the retirement world, really, because there's now almost 14 trillion sitting in seniors' houses, people my age, 62 and older, just their primary residence.
Yeah.
That is the largest single asset class in the history of the world.
Amazing.
There's never been that much money in one asset class, which is primarily unmanaged.
Unmanaged.
People manage IRAs and life insurance and ETFs and all of the other things, annuities, cash value life insurance. But the money in the house is you just put it there and you leave it there and you don't do anything with it and just give it to the kids who don't want it and promptly sell it.
Right.
So it is just a very strange thing that people don't pay attention to it. But they've been trained that way. And I cover that, of course, in my book, that I grew up in brought up by Depression-era parents. And they just said, you just pay off your house and that's what you do as quickly as possible. Right. And I went to mortgage burning parties in in the 60s.
Yes. Oh, yeah.
And that's just what you did. You paid off the house so you could live in it and not worry about having it taken away like it was in the Depression.
Absolutely. And so movement mortgage, before we get into reverse mortgages, what they are, who they're for, tell us a little about movement mortgage.
Yeah, Movement Mortgage is a very unique company. We're one of the top 10 mortgage companies in the nation. We do about $20 billion in originations per year. We have offices in all 50 states. But what's really unique about Movement Mortgage that I'm very proud to be a part of, and I wish really I would have found it earlier, is that we're what we refer to ourselves as an impact lender. Casey Crawford, our CEO, decided in the beginning that he started it in 2008.
Okay, so we started Wise Wealth in 2007, so we understand.
Well, great timing.
Yes, that's right.
Well, mortgage companies really did not look very good in 2008, 2009. They had wrecked a lot of things in the country. And Casey said, hey, I think that mortgages are important. Home ownership is important. Let's do it right. And part of what I'm going to do is I'm going to give back to all the communities, and I'm going to give away at least 50% of my profits every year. Well, in the beginning, that was a few $1,000s, and it wasn't a big commitment. To date now, however, he's given away through Movement Foundation just short of $300 million.
Amazing.
Wow.
Amazing. So we love companies that have a story. We love companies that have a mission. Paul, obviously, we talked a lot in our podcast about the mission of Wise Wealth, to help people be free to give, serve, and enjoy life. I was looking at the mission of Movement Mortgage, and it's to love and value people in everything we do, from your first home to the last one.
We that is something that is talked about every single day. We have on our T-shirts or our hats, and we exist to love and value people.
Yeah.
And Casey always says, whenever you got a question about what to do, is it loving and valuing people?
That's awesome. That's huge.
Pretty basic.
Yeah, pretty basic, but I love that because, sometimes, Paul, in the industry, some people sell insurance and they think that they're just out to get people. And same thing in the reverse mortgage industry. I think what Harlan said at the beginning is that's just the general gut reaction. Nope, sorry, reverse mortgages are bad.
Yes.
People sell reverse mortgages are bad, and they shouldn't be. But their motivation is to love and value people.
Wow. Yeah,
that's huge. And so, the amazing thing about that is, so that would mean to me that if someone came to you the people on your team and said, hey, I'm looking at a reverse mortgage, you would tell them if you don't think they should get one.
Well, without question, we will never make recommendations or advice without asking a whole ton of questions. Sometimes people almost get offended. They say, why do you need to know all this stuff? I just want to know about a mortgage. Well, we ask them all kinds of questions going into their legacy, what their health situation is, how long they plan on staying in the house, just whether or not they can navigate stairs. There's a number of times where we tell people the best thing you can do is sell your house, and move somewhere else, not be in that situation. So it's not a hammer looking to find a nail. It's always a situation where how does this fit with everything else? And we hate doing reverse mortgages without financial advisors. Because everything is interrelated. Everything goes together.
So a lot of times we talk to our clients and we're talking about the house, and they'll say something to us like, we're going to leave the house to the kids. We're leaving the house to the kids. And we all know that when they say that, they don't mean they're expecting the kids to take the house and everyone's moving back in. When they say we're leaving the house to the kids, they mean they're leaving the value of the house to the kids. So how would that relate to reverse mortgage? Does that come into play? Like say someone saying, hey, I want to leave the house to the kids.
Well, I once sat outside a Publix grocery store in Florida where we have a second home, and I asked everybody in the parking lot that came out what they're going to do with their house. Immediately, the answer was, I'm going to give my house to my kids. What you just said. But then I asked them a second question. Will your kids ever move into your house? And it just kind of stopped them. They look back and forth. What do you think, Billy's going to move down here? Or, well, maybe Susie will take it over. And they were still talking about when they're putting their groceries in the back of their car.
That's funny.
And so the fact is whenever we look at a legacy, you can give with a cold hand or a warm hand. Somebody told me that a long time ago. I've never forgot that. And so many people say, well, I'll give my house to my kids when I'm dead. Well, if you're 90 and the kids are 60, what are they going to do with it? They probably have their own house. So if you have a certain legacy, one of the things that I do, and I've encouraged a lot of our clients to do, is let's take a look at what we can give to the kids while we're alive, or give to charities, or give to our church, rather than waiting until we're dead. Where do we get this idea that we can only give money away when we're dead?
Exactly.
It's kind of strange. And then you have to take a look at, okay, how are we going to give this legacy? And we always compare what we call bucket 2 and bucket 3 money. You will look at buckets in your book as well. Our bucket 2 is what a financial planner manages. Bucket 3 is the house. Bucket 1 is the client's income. A little different. Taking that specifically, you'd break bucket 2 into a number of other buckets. But the issue is what's the best way to leave money to children, charities, churches, whatever your goal is. The best way to leave it is out of bucket 2. Life insurance and Roth IRAs are far superior
tax-free methods
to leaving a house. And so we take a look and say, okay, if you live off your house and you use some of your house money out of bucket 3, that will increase what's in bucket 2, and you can be more flexible. The products that you folks have are far more flexible, far more tax efficient. Everything makes more sense. My children know that they're going to get life insurance proceeds. They're going to get Roth IRAs. And they also know that they're going to get money from us while we're alive. We do reverse mortgage vacations. We pay for every vacation that the kids want to plan, as long as they take us with them. And that's a requirement, and that they plan it.
So instead of the kids, after you die, taking the money from the house and going on vacations without you, you know what I mean? I know Tom Hagner talks about these kinds of things. It's like, what are the kids going to do? They're going to buy the boat, go on vacation, all these things that you didn't do because you were going to give it all to the kids. So take the reverse mortgage, take the money out, go on vacation with your kids, have those memories instead of giving it to them after you're gone, and they go do these things. I think that's awesome. So I want to talk to you about some of the things people use reverse mortgage money for, and then I really want to get into how do you get it. So what are some of the things, there's a lot of things coming to mind. You mentioned one that's a great one, and that is, hey, instead of waiting until you die, give your kids some of this money with a warm hand instead of a cold hand. You could actually gift it to them. You can gift it to charities. You can make memories with your kids with the home equity instead of just giving them money after you die. So outside of giving, what have you seen some of the uses? Why would someone take a reverse mortgage?
Well, there's two factors. There's people that need a reverse mortgage.
Okay.
We just had somebody call this week, and he's 92, she's 90. They're almost out of money, and he's got to keep her in a care home. And that's a needs-based scenario.
Yep.
And then there's people that simply never saved very well. About 50% of the people, as you know, and have not saved well. And they have to get a reverse mortgage because that's the only, it's either sell their house or they've got to move. And then there's the once-based people that are not being frivolous about it, but they're looking at things from a overall math standpoint. And that's people like myself, for example. I'm still working. I can afford to make a mortgage payment. But as soon as I got to 62, I stopped making my mortgage payment and sending money to bucket 3 to my house. So I could send it to bucket 2 and give it to my advisor instead, so I could increase the money there. That should be the single biggest use of a reverse mortgage. 40% of people when they get to 62 are still making a mortgage payment.
Okay.
If they stopped making a mortgage payment, even if they can afford it, and redirected, we call it misdirected funds. They're sending money and turning cash into illiquid home equity. If they said, I'm going to redirect these funds to bucket 2, that all of you are very good at putting together with your team here, then that makes way more sense than continuing to send it to bucket 3 to the equity.
Needs-based versus wants-based. So I'm going to go back to wants in just a second, but needs-based. For some people, Paul, they run out of assets or they don't have enough assets to get the income they need. And so they might live on Social Security and have equity in a house and just a few assets. And so someone could, in essence, turn the equity of their house into an annuity, into an income stream or a cash pool to choose from. So that's one thing that's interesting, a needs-based way. Some people, they have to, it's the only asset they've got left. But more than likely, our clients, people we're meeting with, it's not going to be a needs-based thing. It will be a wants-based thing. So you mentioned age 62, still having a mortgage. So the whole idea there is saying, why keep making a mortgage payment when you don't have to from that point forward? You could take that same money you were making and paying the mortgage, put it into our growth bucket, let that money continue to grow. It's liquid, it's available, instead of something that's not liquid, not available, and you're going to be giving it to the kids. And you're saying that to you is like the number one use of a reverse mortgage.
Well, we've done the math over and over. It doesn't matter if it's Money Guide Pro or any kind of e-money, any of the standard software programs. When you start running the numbers through, it doesn't make sense to send money to the mortgage.
Interesting.
One lady said to me once, I don't believe in reverse mortgages. And I said, well, this is not a faith-based product. It's a math-based product.
That's right. Exactly. That's right.
So, the fact is that if you take a look at where should that money go, because a lot of people say, I feel safe if I have my house paid off. That safety is an illusion.
Yeah.
Because if you have $500,000 sitting in a house and you need money, you may be in a year like 2009 where you can't get money.
Right.
Or you can't sell your house quickly. Or you simply can't get a home equity line because you're disabled, or because you're sick, or your credit went bad, or whatever.
So, and you're saying it's not a math problem. So it doesn't matter what interest rate someone says. Hey, I've got this, 3%. I've got this 8%. It doesn't matter the interest rate either.
No, because
or the number of years left technically on the mortgage.
Right. All ships rise with the tide, and so right now we're dealing with higher interest rates, which in a reverse mortgage is good because the payments are always zero. So I get a larger tax deduction, and for the people that have a line of credit, their line of credit grows faster.
Okay. So practically speaking, someone age 62, they've got 10 years left on their mortgage. You're saying potentially they could stop making that mortgage payment. So practically speaking, what happens? They owe a certain amount right now. Now I'm going to stop making a mortgage payment. What happens to that mortgage?
Yes, so it's like refinancing. You've simply refinanced the mortgage from a forward mortgage, traditional mortgage that you make payments on, to a reverse mortgage, which has optional payments.
Okay.
So a lot of people are confused and say, well, I don't want a reverse mortgage because the balance keeps going up.
Yeah.
Well, it doesn't have to. You can make payments if you wish. But every month I get this statement that says, this is not a bill. So, and it shows how much interest has increased that particular month. So I have an option of either sending money to the mortgage and keeping my balance down and creating more home equity in bucket 3, which I do not need or want. Or I can send it to my advisor. I can send it over to you and say, hey, I've got $3,000 a month. I'm not making my payment anymore. What should I do with it? And then you run the math and show me what's going to happen, because a lot of people say, well, my payment's only $800 a month, or it's only $2,000, and it's easy for me to make. Well, that isn't the point.
That's not the point.
The point is what's the most efficient thing to do with that money? So I always tell people, sometimes I'll make double payments, triple payments. The biggest mistake, I believe, that's going to go down in history in retirement is people trying to pay off their mortgage from 50 to 60. It is a huge mistake because they make double payments, triple payments, and a 3% mortgage, and they neglect putting money into the investments that are so powerful that you have.
So from a mortgage standpoint, though, the balance just goes up. So in other words, they have less equity in their house, but they have more equity in the growth bucket.
Exactly.
Okay.
So my right pocket has less equity. My left pocket has more money in my investments.
Okay. So someone has a mortgage, they turn 62, which is obviously we're going to come to that. That's the key age. You can't get a reverse mortgage before age 62.
Well, in some states you can get them at 55.
Okay.
So for example, Minnesota and Wisconsin, they're not available there yet.
But most, it's 62.
Right.
Okay. So let's say someone doesn't have a mortgage. We're talking about someone who has a mortgage, stop making payments potentially. Your mortgage, your balance goes up, but later on the equity will pay it off and you have your equity in the growth bucket. What about someone who's 62, 65, house is paid off, they have no mortgage? Is there a case where they should get a reverse mortgage for the wants-based scenario?
Quite frankly, most people should. Not a few, but most. And I say that not because I'm in the business of selling them, but because of the fact of the amount of math that I've seen. Because again, it's not a question of need. So the unique thing about a reverse mortgage, you can get money three ways: the monthly check, which most people don't need. If they planned with you, they don't need a monthly check at 62. So the other way is a lump sum. They don't need a lump sum either, because they're fine unless they want to buy a motorhome or something, or they want to pull money out for doing a major addition to the house. But they can get a lump sum.
Or a vacation once a year.
Or a vacation, yes. Or they take out a line of credit. And everybody says, well, I can get a line of credit at my bank anytime I want. Well, that's not really true, because in 2008, that wasn't the case. But let's just say that you can get a regular line of credit. The reverse line of credit is superior by far in three ways. Number one, you can pull out money and you don't have to pay it back. So there's no payment. So why take out $100,000 and pay back 150? What does that accomplish? You're just kicking the can down the road. The second thing is it can't be taken away. Any other line of credit can be canceled. It can be
This is the key.
called.
It's federally insured.
Absolutely.
Okay.
So I will guarantee the client that it doesn't matter, come hell or high water, no matter what goes on with the economy, you are going to have access to this money. You will have liquidity. You may not need it today, but you don't know what's in the future. In your book, you talk about all the risk. It's scary out there. There's a lot of risks. You're going down a retirement road that has 10 risks that you clarify in your book. So we don't know what risk is going to bother somebody down the road. So put that in place. But the third most important thing, and kind of if there's such a thing as a sexy thing about the reverse mortgage, and kind of exciting, is that it's guaranteed to go up based on the current interest rate. So if I start out with a $200,000 line of credit at 62 and I don't need it, it's guaranteed to go up by whatever the rate of interest rate, which is approximately 7.5% right now. That means it's going to double every 10 years. By the time I'm 72, it's a $400,000 line of credit. By the time I'm 82, when I might need long-term care or something, it's now $800,000.
So in other words, though, the best time to do it, to get a reverse mortgage, if someone says, well, I really don't need this money, you can still get it at 62. Why wait? Should someone wait till 72?
There's no good reason to wait, because you'll get more money at 72.
And it's not costing you, you're not paying a fee every year.
There's no monthly fees. There's no, if you don't pull any money out, there's no interest accruing. So the quicker you get it, it's like saving. You're better off saving at 20 than at 30.
Right.
Not that it's a bad idea to save at 30. It's not wrong to take out a reverse mortgage at 70 or 80.
Right.
It's just better to put it in place
earlier. Get their
early.
Line of credit that just builds. You can see the amount of money that you could draw from if you ever need it for any reason. This is good. I don't know how we're doing in time, Paul, but I want to get to this. So what are the basic rules for a reverse mortgage? Let's just say age 62. I know it's age 62 before you can get one. A lot of people will talk about fees. So let's talk about the fees. What are like the upfront costs to kind of get a reverse mortgage? It's federally insured. Obviously, to me, I always slow down when I say it because that's a big deal to people, because that's the reason why the house can never be taken away from you. I think that's important. So let's talk about some of the rules around when someone get a reverse mortgage, how it works.
Yes. So the important thing is what you just mentioned. What does it federally insure? It federally insures that I'm going to have access to the money. It also insures and guarantees a future value of the house.
Yeah.
So if my house goes down in value and I die in a year like 2009, my kids will not be saddled with the debt.
All right. So what you're saying is, let's say that I took out a $300,000 home equity line of credit, and I'm still living, and so that's accruing. Now I owe $400,000. I die, my spouse dies, the house, someone comes along and says the house is worth $350,000. I owe $400,000. What happens?
You only own 95% of the value of the house.
Okay.
So whatever the house sells for, the kids may not get any money
Right.
because you used it all up.
Yep.
Just like if you use up an annuity if you live long
Yeah.
enough. But the fact is that none of that bill is going to be passed on to the kids.
Even if it's upside down.
Even if it's upside down. My uncle died in 2009 in 94. It was one of my first reverse mortgages.
Yeah.
He was upside down by 50,000, exactly the number
But
you're
the
talking
kids
about.
did not pay for that.
Paid nothing.
Yep,
And
that's
the
the game.
300,000 that he had in his other investments
Yeah.
at his visor, all of that went to the kids.
Amazing. So they don't touch that. Yeah, so that's huge. So that's the federal insured part of it. So,
And that goes to the costs.
Yes.
So I have to pay
Yep.
a fee of 2% of the value of my
Up front.
house up front as part of the equity. I don't write a check for it. It just
Yes.
gets subtracted
it
from
gets
my
added
equity.
to your loan.
Exactly.
Okay, it's the mortgage.
All their costs are the same. Appraisal.
But you
title.
don't write a check for that.
No.
Okay,
It's-
so you
pay for it
have
with
like
equity.
a origination fee or whatever the case may be, and that's kind of like for the federal insurance and all the costs associated with appraisal. So someone would have to get an appraisal. There would be let's say 2% cost to get the reverse mortgage in place. Anything else anyone needs to know about fees?
The normal fees in any state has tax stamp fees or
Closing costs, right.
title costs and all that. So everything the same as a forward mortgage
Okay.
that they've done in the past. The only difference is that 2%,
2%.
which is a lot.
Yes.
But all of the fees, there's nothing that they write a check for. All of the fees come out of the equity.
And theoretically, someone could write a check for that.
They could.
They could. Same thing with writing
Yes.
a check. Okay, so
We just tell them
or
it's
just
better.
add it to the mortgage, or
They're just
okay.
better off giving it to you
Yeah.
because there's better places in
getting
bucket two.
invested in that kind of stuff. So, and then does everyone have to take a class? Is there counseling
There
for anyone
is.
that needs a reverse mortgage, or what's the sort
Yeah,
of that?
somebody
Yeah.
told me we don't need counseling. We've been married for 40 years. We don't need money counseling.
Yeah.
We're doing great. And
Yes.
I said, well, that's the rules because they're looking for three things. They're looking to make sure that our numbers are fair and correct, and so it's because it's federally regulated. They're looking to
Yeah.
make sure that they're of sound mind and
Yeah.
body,
Yeah.
or sound mind. Doesn't matter
Yeah.
about the body, but they have to
Yeah.
be wise in knowing what they're doing, and they
Yeah.
can't have dementia.
Yeah.
So the class is just simply to clarify those.
Is it a short class? Is it online? Is
1
it in
hour on
person?
the phone.
1 hour on the phone. Okay. And so, Paul, I mean, you're the Medicare guy here, the Medicare specialist. Same thing. We're talking about government programs.
Yes.
In essence, a reverse mortgage. I don't know what HECM stands for, but
Home equity conversion
mortgage. But I know we can talk about that one in a minute if we got
Yeah.
time. HECM for purchase. But the whole point is the government, if they're going to give you people this thing, the Medicare, you have to make sure people are educated before they can get a Medicare thing. Not anyone can just do Medicare. Same with this. There's education involved.
And I do have a question for you. So if someone takes money out, they have a line of credit, they take money out because they want to they need to replace a roof, they want to buy a new car, they want to take a trip, something like that. Is that treated as normal income tax?
No, that's what's really great. All of the money coming out of a reverse mortgage is tax-free because it's not income. You did not sell your house. You borrowed the money. Borrowed money is never taxable. If you borrowed $30,000 to buy a car, that's not taxable. Same thing with the reverse.
So it doesn't impact Medicare premiums. You don't go into IRMA brackets. You don't pay more income tax. But if you take money out of your IRA, you do.
Exactly. And so the tax bracket situation, we worked with Ed Slott, who obviously does a lot of work on the IRA side. Him and I did some presentations specifically on that,
Yep.
of how that works against Medicare IRMA, Roth conversions on IRAs.
Yes.
None of the money coming out of the house is taxable, and so it can help with the bracket creep. Some of our clients save $10,000 a year just because they're pulling money out of the reverse and lowering the money that they're pulling out of their IRAs. which completely wipes out the IRMA problem.
Yes.
So many ways to use this. And we've had Ed Slott on our podcast, and he's been a guest here at our events too. So, Paul's a master at asking questions that he knows the answers to bring some. That was awesome, Paul. That was huge, because that's a very important point.
It is.
The tax-free, impact of taking money from a reverse mortgage, not taking it out of an IRA. Potentially, Paul, as you mentioned, that it is converting IRAs to Roth IRAs, taking the money from the house to pay the tax on that, and so you leave Roth IRA. There's a lot that can be done there.
There's another really cool thing with taxes, which is one of the main reasons why I got my reverse mortgage early, because remember, I didn't pay my house off. So I used the reverse to pay off the forward.
Yeah.
In 2017, when the tax law changed, the only thing that's deductible is acquisition debt. So acquisition debt interest is deductible, but they raised the standard deduction to almost $30,000 for a couple. So there's only 8% of people that are taking deductions on their mortgage anymore.
Yes.
Well, I can stack my interest and let it go for 2, 3, 4 years, and once I'm way over 30,000, I can write a check for that from my IRA and get a 1099 income, but then I get a 1098 deduction, and I will save probably $250,000 in taxes if I live to be 80. Just doing
We need to look at the timestamp on that. I got to remember that one. That's a good one, Harlan. I never thought about that one. That is a technical, but that's a good one.
Very technical.
Yeah, I like that one. Very good. So, people, it's federally insured. What happens when one spouse dies? There's two people living in the house, one spouse dies, or how does that work?
Let's talk about that, because that was the biggest black eye that we had, because previous to the 10 years ago on the ruling, an older husband could take their wife off from title and do a mortgage by himself, which was wrong. It was legal, but it was stupid. And there's a lot of things that are legal, but you shouldn't do that. Well, too many husbands did that, because the older you are, the more money you get. So they'd take their wife off. They'd have a grand old time. They'd die, and their wife would get kicked out of the house.
Right.
ARP had a lawsuit against that. The rules all changed. And 10 years ago, and my wife was underage when I did my reverse mortgage. Not under 18, she was under 62. Underage is under 62 for us. She was 59, but she could be a part of the mortgage because I was of age. So if I die tomorrow, she can live there until she's 150. There's no requirement for her to move out.
Amazing.
So that is
pay it back.
And she doesn't have to pay it back. If she wants to sell, she can sell and take the equity and go somewhere else and live elsewhere, or buy a smaller house. It's up to her, but she is guaranteed not to be required to move as long as she continues to pay the taxes and insurance and lives in the house. That's the only requirement, the only rule that I didn't finish off before. You have to be 62, and it's got to be your primary residence. You got to live there. Most of the time.
So primary residence. Okay,
primary
good.
Residence.
Yep.
So if it's a second home, you can't do the reverse mortgage on that.
Gotcha. You know how it works with Medicaid? If someone has a reverse mortgage and all of a sudden they have no assets left, the reverse mortgage is tapped out. And they need to go on Medicaid. You have any thoughts on that? Yes, exactly. I know. I just opened that can of worms.
I work with a lot of estate planning attorneys across the country, and this is a huge Medicaid planning tool, because any money in a line of credit, you can have $1 million in your line of credit, and it's not a countable asset.
Amazing.
There's
a lot here.
You can help people live at home and get home care.
Right.
You can help somebody qualify for Medicaid. We just did one of those in Indiana last month. He has his wife in care, but he's doing okay. And he's going to have to do the spend down, but he doesn't have to do the spend down if he pays off his mortgage instead and uses that money to live on. So he has some money in the house.
So many uses, as you talk about that. I know some people use reverse mortgage to buy long-term care. Some people use reverse mortgage to buy life insurance. Instead of leaving the house value to the kids, buy a life insurance policy, leave that to the kids because it's tax-free. Some people use reverse mortgage money to fix the house so they can live in there longer instead of going to assisted living, those kinds of things. So many uses for it. One last question on this, because I know we're running up against the clock here, but HECM for purchase. So let's talk about that real quick. How does that work? Someone's over 62. And they need to move or they want to move. How does that work?
Movement is one of the biggest proponents of that. We work with more realtors in their offices than any other company. We are very concerned about the purchase market because we know that according to the U.S. Census Bureau, 90% of people my age are in the wrong house. If they got into a wheelchair, they could not come home.
Yes.
Horrible. And just plan ahead and be in the right house. My wife and I are still very healthy. She bikes all the time, and I can take steps 2 at a time, but there might come a time when we can't. We're in a house that we can stay there even if we have wheelchairs. So there's so many people that should sell their old house and buy the next house. But they're afraid to, because either A, they have their other house paid off, and the next one is more expensive, or B, they have a 3% mortgage and they don't ever want to give that up because they know they'll never get it yet. A reverse for purchase, they'll bring the payment out of the old house and then be able to buy the new house with no payment for the rest of their life and set up a huge tax deduction. We just did one where they sold their house for $250, bought a house in a 55 plus community for $400, 0 payments, 0 money taken out of their investments, and they moved from $250 to $400 into a brand new maintenance free house.
No mortgage.
All on one level. They've got a mortgage, but no mortgage payment.
Right, I gotcha.
And the reverse for purchase, there are so many people that should do that. And quite frankly, the baby boomers are screwing things up for the young kids.
Generally speaking, is it safe to say someone could, I guess, buy a $600,000 house as long as they have half the money in equity in your other one, something like that?
You need
about $300,000 down.
You need somewhere between
50.
40 to 70% down, depending on your age.
Okay, I got you. Depending on your age. The older you are, the more you could.
The more you can borrow, and the less you have to put down.
Harlan Accola.
Yes.
Amazing, man. This is great. Home equity and reverse mortgages. That book, obviously, your book goes into this. Any other resources you'd recommend out there for people? But besides your book,
well, yes, one of my coworkers, Dan Hallquist, wrote a book called Understanding Reverse and Navigating Reverse, and that's kind of the nuts and bolts. It's not a competing book with mine, but just completely different scenario. And for the engineers out there, Dr. Wade Pfau, PhD, CFA, he wrote a book, 3 books on reverse mortgages. They're boring.
Most of his books are, but he knows a lot.
They're incredibly brilliant.
Like you said, this is a math problem, not a faith problem or something like that. But awesome. I appreciate it. Look forward to having you speak at our client event as well, Paul. This is great. This is why we do this.
Absolutely.
People need to be educated, and certainly every time I hear about it, which I don't think about it a lot, to be honest with you, right? I'm in a different world, different context. But when I stop and think about it, I realize, how many ways it can be used, how powerful it is. So thank you, Harlan, for being on the podcast today.
Thank you. We appreciate the opportunity to spread the word.
Yeah. Thank you, Harlan. Thank you, Stephen. For you who are watching or listening to this, if you have questions, it's simple. Just give us a call. Pick up the phone, give us a call, 816-246-WISE, 816-246-9473. Send us an email at info@wisewealth.com. We'd love to be able to start the conversations with you, be able to help get answers for you. We can put you in contact with people that we would trust who would be able to help you with this if it makes sense. And so, as Harlan, as you mentioned, I appreciate that you don't do this just lightly, but you want to do it in context with and in concert with the financial advisor, because it's a piece of the whole plan. So again, we always encourage people not to just chase things, but to have an understanding of why they do what they do financially, how it fits in the entire context of the plan, because the plan determines the products. And so if you have questions, reach out. It starts with a simple conversation just to get clarity. Well, we call it the clarity conversation. And so reach out to us, start that conversation today. We'd love to talk to you. So again, thank you, Stephen, for having a great guest on. Thank you for finding people like Harlan. Harlan, thank you for taking time out of your busy schedule to come down here and talk to our audience today. We appreciate your knowledge and your passion for this too. It definitely comes through. So we appreciate that. And of course, our last thank you goes to you, our listening viewer and audience. You're the reason we do it, and we wouldn't be here without you. Thank you for tuning in to the Simplify Your Retirement podcast by Wise Wealth. And we appreciate you watching this. Like, subscribe, share. Those are ways that we can get this message out, and we will see you next time. Thanks.